I'm Kristine Hankins. Thank you for having me. This is just such an honor to be here and to be able to talk about what I work on from a research perspective, but also to just have the opportunity to kind of reflect on how I've gotten here. Many of you have known me for many years because I've been at Gatton for more than 15 years, and Gatton has supported my growth since my first days as an assistant professor. And so it's just such a pleasure to have this opportunity to kind of say where I've been and where I'm going in the future with my work. So in a nutshell, I think about firms and risk. Risk is everywhere, and risk comes in many flavors. When firms think about risk, they're going to think about reputational risk. They can think about trade policy. They can think about direct exposures. They can think about climate change. There are so many forms of risk that matter for firms, and they matter for firms because they matter for cash flows. And cash flows matter because that's what allows firms to invest, to hire, and to grow. Risk matters, so risk management should matter. We should know a lot about this. And yet, historically, there was a very large disconnect between how we thought firms should manage risk and what we were actually able to see on the ground. So, why do firms manage risk? They want to have money to grow their firm. And yet, when we looked at the evidence, it looked like they were doing very sort of not big picture risk management, but focusing on narrow transactional exposures. We also thought, who should manage risk? Well, the firms that have growth opportunities, that are constrained, that are small, that don't have good access to the capital markets. And what did we see? Well, when we looked at who was actually using derivatives, it was concentrated in large, highly profitable firms, and they actually stopped hedging as they got close to distress, when they became constrained. So this quote I like: empirical support was limited and mixed. And that's about where I came onto the scene. So my first paper was my job market paper, and I just said, well, what if we redefine the definition of hedging and take a broader view? What if we think about this as more than derivatives? Firms can do lots of things to manage risk. They can hold more cash. They can change where they operate. They can change their leverage. And so what I did was say, let's look at a very specific environment where we know a lot of details about what the underlying exposures are. And I looked at banks. Banks have to report a lot. We know they have clear exposures to interest rate risk, so we can actually see how they are managing their exposure risk, as well as a lot of information about their broader business activities. Imagine two mergers. In the first merger, we're going to combine two banks that look really similar. They have very similar cash flow volatility over time, and when you combine those two firms, guess what? You have a bigger bank that looks pretty similar. Same cash flow volatility, and when those two banks are merged, what we see is relative to their level of interest rate exposure, they don't change their hedging. Now imagine we have two banks that are completely different. They're in different markets, they have different business models. They have very different cash flows. And when we put those cash flows together, they actually start to even out. They're going to balance out. And so when those two banks are combined, we can see relative to their level of interest rate risk, they actually reduce their hedging a lot. And so that was the first evidence we had that said firms aren't focusing specifically on the transactions, but their behavior actually does line up with theory, that they're thinking more holistically about what operational decisions are doing to their total risk profile. And so this was my job market paper, and it was the idea that let's think about what firms are doing. They do recognize the hedging benefits of operating decisions. Now the next paper dove into, do firms actually intentionally make operating decisions to manage risk? And at the time, there was a big focus on merger waves. We know mergers are big events for corporations, but why were we seeing them cluster in time? This paper, we got into what the type of merger was. Firms can merge and just make themselves bigger. But they can also vertically integrate. So they can actually acquire a supplier or a downstream firm, and that's a very different type of merger. And that's a merger when things are uncertain that have hedging benefits. Because as uncertainty increases, writing contracts with suppliers and downstream firms, you want to buy inputs. How many inputs do I need next year? When it gets really uncertain, those are harder contracts to write. And so what we did was we dug into what was happening in industry level uncertainty, and we saw that that's when we were seeing more of these merger waves. And then we dug into the actual mergers, and we saw during these merger waves, they were not just pursuing any type of merger, but in fact were targeting these vertical integrations. And so this not only said, yes, they recognize the hedging benefits, but they actually seem to be intentionally pursuing operational decisions to deal with uncertainty. And this also allowed us to say they're not focusing on managing specific transactional exposures, but the risks that firms are thinking about is actually much broader than what can be addressed with a derivative product. I then had a series of papers that sort of explored different facets of how firms use operational decisions to manage risk, as well as the definition of what is a hedge. And not all cash is a hedge. And so just trying to sort of think more broadly of how do we understand corporate hedging. And in revisiting the definition of what is a hedge and what companies are doing to manage risk, this allowed me to go back to an earlier question, which was why do firms stop hedging as they get constrained? Or my little squished piggy bank. Why do they stop? And what we found was if you take a more holistic understanding of how you define hedging, they actually don't stop hedging. They stop using derivatives because those have really large collateral constraints. And what they do is switch to alternative hedging products. So they're just changing tactics. So redefining the definition of hedging allowed us to understand that this actually does sync up with what theory suggests. Now, we have done a quick hopscotch through my CV in about 5 minutes, I hope, and I want to take the remaining time to go into a little more depth on a project that I'm very excited about right now that has a lot of familiar themes in the sense I'm thinking about how firm boundaries affect the way that firms think about and manage risk. And yet, for PhD students in the audience, sort of how you can take a core skill set and pivot it into a new research area. I'm going in the direction of both trade policy and household finance. So a very different spin than my existing work in corporate. So in the economics literature, there's a lot of focus on how much trade policy and tariffs pass through to the prices paid by American producers and consumers. So this is a risk management question. If you are hit with a cost shock, does your firm absorb that shock and have less money, or are you able to pass it through to the prices paid by the people you sell to? Now, as a corporate person, my question is how do the boundaries of the firm impact the way you would respond to a tariff cost shock? And the insight in this paper is there are many firms that not just make goods, but they also provide financing for the people that buy these goods. And this is very common in durable goods manufacturing. So durable good manufacturers are a very large provider of credit on the level of many large top banks. So while this is sort of a corporate question in the sense of does the way your firm is organized allow you to respond to a tariff cost shock, it also goes to a bigger question of my interest in how do we measure things. And it said, how do we measure hedging? Well, this is how do we measure the impact of a tariff on prices? If we only look at the price of the good, we may have an imperfect measure of this cost of the trade policy. So our laboratory is we look at the 2018 Trump administration metal tariffs. They very quickly enacted tariffs that were substantial on both steel and aluminum. This was a large cost shock to the US auto manufacturing industry. And as we know, many auto manufacturers both make vehicles as well as have integrated captive finance units. We think that the auto loan market itself is just a very important, interesting thing to know more about. This is a provision of credit that is very pervasive. So it is the third largest source of consumer credit after mortgages and student loans, and is 3 times more common. But this is not just an auto loan paper. Many durable goods manufacturers have these captive finance divisions. Firms like Caterpillar, Polaris, Boeing all mention the metal tariffs and all provide captive finance lending. So this is not just an auto loan research question. But when we dive into the empirics, we're going to focus on those auto loans. We can also look at vehicle prices, but our focus is going to look at the variation in the auto lending market and allow us to compare the loans that are made by captive lenders that are in these auto manufacturers that are hit by the tariff cost shock to other lenders in this market, like banks. All of these people are players, and so we have a very nice benchmark to compare. We have highly granular data where we are able to say, for a new Honda Accord purchased by someone in the same state, in the same month, with the same credit score and the same income, before and after, within 12 months of this tariff, what does the change in rates look like? And the punchline is that these metal tariff costs are passed through the captive finance unit to the cost of financing for these auto loans. So consumers are receiving worse terms after the tariffs because when the firm responds to the shock, they can not only just pass it through to the vehicle price, but they can also pass that cost through to the financing term. We actually don't see any change in the vehicle price, and that also is interesting. So the question is, why do tariffs pass through the financing channel and not the vehicle channel? And more importantly, can't people just shop around for better rates? There are 3 big frictions in this market. The first one is that captive lenders generally provide lower financing costs than non-captive lenders. They're kind of bundling the product. They're making money on the vehicle and the financing, whereas the bank just is going to make money on the financing. And this is something we see in other markets. The captive finance lenders generally charge less. So if you're a consumer, you can't just switch over to a bank seamlessly. That allows them to raise the rates a little bit more. Another part is that we know borrower sophistication and borrower constraint matters in purchasing and financing automobiles. People are far more sensitive to the price of the car than the cost of the financing. And the cost of the financing, people that are more constrained or have lower financial sophistication are less sensitive to changes in interest rates. The other piece that matters is how much market competition there is. If you're in a place where there are lots of banks competing for auto loans and lots of different auto finance providers, that's very different than when you're in a more segmented, isolated market. And so what we're able to do is actually break this down and find not only do the tariffs result in higher auto loan costs for American consumers, has a disparate impact on low income, low credit score borrowers, as well as people in places with less lending competition. So, in sum, 16 plus years at Gatton, I like to think about firms and risk, and I think firm boundaries matter for how we understand risk. I think this is a really interesting area, and it has different implications, and now I'm into consumer credit. Thank you very much for listening.